Thank you, councillors. We're back in session again. I'd just like to welcome our manuhiri here today. We have James and we have the Honourable Chris Fafoy to do our presentation on the Insurance Council of New Zealand. I'm not going to take up any time. I'm just going to pass the rake to you and allow you to start your presentation.
Kia ora, Madam Chair. Kia ora koutou, ngā mihi nui kia koutou katoa. Can I also introduce our Deputy Chair of the Insurance Council, Adam Heath, who is also the Chief Executive of FMG, one of our insurers of our 22-member Insurance Council. Can I thank you for the opportunity? I know we've only got half an hour with you, so we're going to try and maximise the time that we've got available for councillors to ask myself and Adam any questions that they may have to make that more efficient. Again, thanks, because we're, as a council, trying to proactively reach out to councils and regional councils to make sure that they have the information that they need from the Insurance Council and understand some of the thinking about how insurers are thinking about longer term issues. So it's really valuable for us to be able to get some time here with the Regional Council. We've spoken to the Hawke's Bay mayors and chairs, and also the West Coast mayors and chairs before the election season earlier this year. And next on our agenda is Horizons and the Taranaki Council early of next year. So we want to thank you for the ability to be able to get our program of engagement done with your council. I do have some slides which I'm going to whiz through, as I mentioned, because I do want to maximise the ability for us to answer some questions. For those of you who don't know who we are the membership organisation, the industry association for the general insurance sector. So we have 22 member insurers in ICNZ, FMG, Adam being one of them, which is very rurally based. Collectively, we cover 95% of the general insurance market, which is about $2 trillion worth of assets and liabilities that we cover, both in a consumer sense and also in a commercial sense. We've got two purposes, obviously, as an insurance industry body, to ensure the long-term sustainability of the sector, kind of bread and butter of an industry organisation. But also in terms of that sustainability, we think it's really important that we're ensuring the safety and protection of New Zealand communities by strengthening resilience to the increasing risks of climate change. So a lot of our message is about risk reduction and what role insurance does and can play in the future, and how we can make sure that we're engaging with the likes of councils and banks and central and local government entities to make sure that we can get that risk reduction in a place where insurance continues to be accessible in the long term. These are our stats from last year. So we had about close to $11 billion worth of what we call GWP, or gross written premium. That's essentially premiums that we collect from customers. And we're nearly close to just a little over $4.5 billion worth of claims from insurers in 2024. Again, we've got 22 members and we support about close to 8,500 jobs in the sector. This is one of our main graphs. I'm just checking that Adam can see the graph as well. Hopefully he can see this as well. This is one of his favourites. This is the pie graph on the left represents a home premium, the standard home premium. Close to 42-ish% of the average home premium in New Zealand is made up, the cost is made up of levies and taxes. So we are responsible for collecting the levy for the fire and emergency. We collect that levy, which is in the kind of yellow portion there, also for the Natural Hazards Commission, and also GST like everybody else. Our main message is that there's a lot of money that isn't necessarily insurance related that people are paying for when they're paying for their house premium. And the blue section there is what our members use to price their actual insurance, the technical price, and send signals to their customers about the level of risk for their properties. When it's kind of close to 50%, that's a bit of a challenge to send those risk signals via an insurance premium. So one of our jobs in the regulatory space, which is one of our strategic priorities, is to make sure that we're doing everything we can do to ensure that we can keep those regulatory costs reasonable, and make sure that we are sending signals and good signals through the premiums, so New Zealanders can understand the risk around their homes. On the right side of that, we're kind of trying to think long-term. Insurance accessibility in a time when cost of living is a challenge is obviously something that we are concerned about immediately, and it's we understand that challenge. But in the long term, with increasing likelihood and frequency and severity of weather-related events, the accessibility of insurance for some places around New Zealand, primarily given coastal risk and flood risk, is going to be a challenge in the long term. What we heard when we went to see reinsurers earlier this year in London is that they are watching New Zealand in terms of our planning laws, our building laws, to make sure that what we call at RCNZ, when we're not continuing to build in dumb places. One of the things that the reasons why we're engaging with councils is to make sure that we're working with councils to understand some of their challenges, so we don't fill the problem bucket up as we have in history. Again, that's one of the things we're trying to do with these engagements, and to build up the relationships. Very quickly, traditionally, this is the cost of weather-related claims here in New Zealand over the last 60-ish years. More recently, you can see that there's been a trend upwards, and in the last 10 or so years, weather-related insurance claim costs have somewhere been between $250 million and $350 million per annum. That has obviously been an increase over that short period of time over the last kind of 20 years. And then in early 2023, you will all have known that there were two relatively large events in the short space of time. This is that same graph on the scale, including 2023, where those two events in Auckland and Cyclone Gabrielle took what was BAU, somewhere between $250 million and $350 million in insurance-related claims, to $3.8 billion claims, primarily just for those two events in that 1 year. That has had an impact on the way that insurers and reinsurers look at insuring New Zealand in a climate sense. Again, when we went to London with some MPs and ministers and half of our RCNZ board, the reinsurers are saying, we understand the seismic risk in New Zealand, that has been long held, but we're still getting our heads around what the climate risk in New Zealand is, and how we model that, and what that might mean for the future insurance of New Zealand in terms of price and accessibility. So that was a bit of a wake-up call in terms of climate-related risks for insurance claims in 2023. I'm just going to whiz through these next ones very quickly in order to make sure we've got time for questions. I think this council will know just about the kind of risk it precisely has itself around coastal inundation and inland flood zones. But the MFE put out some stats this year kind of pointing out just how much of a risk those things are. I think the one at the bottom around infrastructure might be pertinent to your region. Sea level rise of 0.6 metres would put that level of infrastructure at risk, and obviously the replacement value at just a little over $26 billion is sizable for the system. Insurance in these coastal areas, we say, is still generally available. There are some places that are precisely a challenge at the moment, and I think you're probably aware of some of those. A lot of our members for some years now have been moving towards increased risk-based pricing. You're seeing that become the norm in the market. We're here to also talk about the levers that central and local government can pull to make sure we are reducing risk. We've heard lots of stories of the kind of infrastructure and investment and policy decisions that councils around the country have made in order to reduce risk, primarily to protect communities. But from an insurance perspective, we are very supportive of that, because it also reduces the loss risk for those communities, and then obviously can make the underwriting experience probably a more positive one for the community and consumers as well. Again, we do want to make sure that we're sending the right signals to global reinsurers that continue to send their reinsurance to New Zealand. They are watching our planning laws. They are watching our building codes. They're very interested in not just individual decisions that are made in regions, but also I'd be interested in the likes of the RMA changes that were announced yesterday to see what kind of powers are given to councils to make decisions that are going to keep communities resilient. And while I know this is a challenge precisely for all councils at the moment, we had a signal from the Minister of Finance earlier this month or at the end of last month about where they think the responsibility lies in terms of the investment in some of the resilience measures in communities, and that it was with councils. We understand the kind of wider challenge in amongst that, but the investment in resilience, acknowledge that. But we, from an insurance perspective, the investment in resilience not only will protect the communities, but also ensure that we can do our best possible job to maintain accessibility of insurance long term. Again, those signals are sent to our members, but also to reinsurers who kind of underpin the large loss factors for our insurers as well. I think I've probably taken up enough time. I'll just check with Adam if he wanted to add anything before opening up from questions from the floor.
No, I think you've explained it really well, Chris, and I think probably best placed to now just see what the council members have on their minds in terms of any questions.
Thanks, Adam.
Councillors. Councillor Graham?
Thank you. That was really interesting. Just a question. So going to your point about reinsurers, looking at New Zealand and our planning laws and things like that, and looking at our reassurance potential with that, thinking about the fast track, some of the housing projects there are fast tracking projects that have liquefaction and flooding implications. And I'm just wondering if you're having input into those fast track process.
Not on an individual basis, but we certainly did submit to the legislation as it was going through those committees, the select committee stages. We are aware of the balance that we have to strike in terms of, development continuing, but it continuing without taking heed of kind of warnings and data and modelling around the increased natural hazard risk. We think is in the long term going to be detrimental to not just the communities, but also the long-term accessibility of insurance. When, again, I don't want to sound like a scratch record, but the reinsurance that we get internationally underpins a lot of what our members do. And I was actually quite surprised about how closely the global reinsurers are watching New Zealand in terms of the detail of the planning laws and their enablement. I think we're not alone in this. It's a global thing that we're putting settlements traditionally in places which have been quite prone to high natural hazard risk. And I think it's going to be a challenge for New Zealand if that trend continues, for reinsurers to be happy to cover the same kinds of risks that they have in the past. I might just defer to Adam as well about how, as from an insurance perspective, how they reconcile all of those things.
Yeah, I think the key thing to realise is that there isn't an insurer in New Zealand Aotearoa that could carry on business without the support of the global reinsurance markets. But New Zealand as a whole only represents less than 1% of total reinsurance premium globally. So we're a very, very small player in terms of their income base, but we can be quite a significant player in terms of claims costs. So like when we had the Canterbury earthquakes, that was at that point in time the third most expensive insured event in history for reinsurers. So they are very keenly attuned to New Zealand. And if you take, for example, FMG, so Cyclone Gabrielle was the single biggest event we've had in our 120 years of trading in this country, and that claim, those claims for us were somewhere in the vicinity of 320 million. Actually, reinsurers picked up the bill for over 300 million of that. So they are very attuned now to what's happening, as Chris described earlier, around particularly weather and or flooding related risks, and what we as a country are doing more broadly to adapt to a changing climate, but also to what we're doing around prevention and mitigation. Back to you, Chris.
Just on top of that, I think the theme that we got from the reinsurers right across the board is that adaptation isn't an option for New Zealand anymore. It is an absolute must in order for them to continue to be confident to send the levels of reinsurance for the type of risk to New Zealand. So one positive is that for a couple of years in a row now, the reinsurers have said at a very early stage that they think New Zealand is quite advanced in terms of its adaptation policy thinking. I think they're impressed with the thinking, and now they're kind of looking towards the actual activity and actions. Yeah, so I think the implementation of the likes of the National Adaptation Framework, which Minister Watts announced about a month and a half ago, and clear paths for investment, if required, in areas to reduce the risk in some communities. I think that's the biggest challenge of them all.
Any further questions, councillors? Councillor Crosby, Councillor Kumar.
Thanks, Chris. What further, or what could councils do more? This is a generic question, not specifically to this one, in terms of its asset management and mitigation against risk on its own assets, to get better premium rates and or deductibles. There's sort of a schedule of things we could do.
I think taking a relatively proactive and mindful that there's costs involved here, I think I'm kind of trying to describe utopia here, approach to the natural hazard risks in the area. And I also think at a level when we're not quite there yet, we've kind of had discussions about how we might do that, but the more engagement that we can have while you're working through that process with the insurance sector. So I guess you can understand what we might need to understand about the nature of that kind of infrastructure, or how that is woven into some of your long-term planning around land use. It would also be important. Mindful of something that I think we've all been warned about for this meeting, I think, and it's also kind of getting for us to have a really good idea of what the management plan and for some of those assets is as well. I mean, again, I think reinsurers are interested in that level of detail about how we're maintaining and how we're going to manage that infrastructure if it's going to be put in place, to ensure that we've got confidence that it's going to do the job that we hope it to do, in order for us, for insurers and reinsurers, to understand how they might take a different look at underwriting the risk in some of those areas.
Councillor Kumar.
Thank you, Madam Chair. Thank you, Chris. Thank you, Adam. Just wanted to know, about 3, maybe 4 years ago, the Waikato DHB was almost under siege because there was some cybercrime related. Just wanted to know whether councils are susceptible or covered for cybercrime.
I'm making an assumption that you are. It's quite a big line of commercial insurance. I'm not sure how big it is with FMG, Adam, but I mean, it's an increasing risk. I mean, as we put more of our operations and data online, I think that certainly from my board and boards in general, the expectations around the security and privacy of that data goes through the roof. So it is a strong line of, as we call them, lines, or a product of insurance. So I think we've seen in the headlines today just how susceptible New Zealand is to that type of incident. So I think it's only going to become more important over time. Adam is probably more in the real space. I'm not sure if you've got anything much to add there, Adam, other than, as a board member, you might have of expectations that others may share as well.
Yeah, sure. So, Councillor, I'd just suggest, and if I'm assuming you place your cover through a broker or a intermediary, so that's a really good question to ask them in terms of specifically what cyber risk are you covered for, and what level of cover do you have to, and to Chris's point, like if I reflect on our organisation and our board, cyber related risk is at the very top of our risk profiling. And we've done a lot of work over the last 3 years to lift our own resilience and posture in terms of cyber, and particularly with AI. Like we just had an AI deep dive last week with our board, and we had an external third party who specializes in this space saying that actually they have now recorded their first ever AI initiated cyber attack. So no humans involved in the process whatsoever. So it is a fast evolving space, and hence why it's really critical for you to receive really good advice around what covers you do have in place and what would trigger those covers and how much cover you do have.
Most nervous time I've had at ICNZ is when we went through our desktop exercise around the security scare on our platform. So we made sure our cyber cover was in good shape after that.
Brayden?
I'm just wondering how you work with regional councils to, I don't know whether there's examples of this already, but where you get to the point where the risks of inundation or coastal erosion are just too great and you're just obviously not insuring an area. So whether it be like a section of houses in Matatā or a region, how you can work with the councils. And have you got any examples you can share where it's just become too risky and that's it, insurance is out?
There are a small number of those types of scenarios where the risk is far too high. I think the most obvious one is what happened after both Auckland Anniversary Weekend and Gabrielle, where we had the categorisation of homes where anything that was basically Category 3 because the life risk was too high. So insurers just said we won't be covering those areas anymore. I think in 20 months into the job, I think it's been a little bit ad hoc in terms of the way that we have worked with councils, but part of the effort to be here is engaging nice and early and building that relationship. So if there is an issue emerging, while our members individually will look at that in an underwriting sense, as a collective and as a sector, we want to make sure that we've got the connections so you feel comfortable enough and have got the links to come and speak to us via the council so we can take as early and proactive discussion about some of those issues. Again, that might be on a spectrum from the hardest decision to make about a community, but also what are the kinds of interventions or policies or investments that you could make to try and obviously increase the safety of that community, and therefore, okay, so what is the insurance lens on that as well? Because if you take an action, we make an investment, and we still believe the risk is, in an underwriting sense, is nominally the same, then it might be a challenge for some of those communities to actually continue to afford insurance in the long run as well. So it is about trying to get that balance of the actual risk reduction in the area, but also what the insurance play in there as well, because there's a reality for those communities as well.
Thank you. Yeah, I see a real benefit between us trying to tell people not to develop somewhere or not to invest, and being able to say, and by the way, the insurance counsellors also forecast that they will not be insuring in this area, so it can help us have those challenging, courageous conversations with communities about what retreat might look like, so that we're kind of on the same page via different sectors, but same. I think
the traditional approach is that whatever has happened at the planning decision is that a council makes a decision, development happens, bank gets involved, and then the insurers usually at the end of that process. And sometimes in extreme cases, people who are purchasing in those developments can possibly get a nasty surprise about what the insurance might be. What we hope is that we can actually have an insurance conversation at the outset of this process. So when you're going in to make some of these decisions, and we've done that already with Hawke's Bay, you can get an insurance perspective on the decision that's before you. We've got to be a little bit careful about how we deal with that with the Commerce Act, because each of our members are obviously in competition with each other. But we do think in a New Zealand Inc. sense, it's really valuable to have an insurance conversation at the beginning of that process, rather than the community find out afterwards. Because as you know, insurance is a 12-monthly product. At that point in time, you might be fine. But if, developments happen, and if, the longer term accessibility of insurance in those areas is a challenge, then I think you probably want to find out about that at the beginning, of the development process as opposed to kind of the community funding that along the way.
And on the flip side, I see the benefit is that if we are going to invest significant funding in something like a stock bank, that we can then quantify the value in terms of insurance savings and
Yeah,
what that equates to in terms of the community on the other side. So
yeah.
I think working together is what sounds like the key message and the benefit for us all.
Yeah, we had that scenario in the West Coast where I think there's been some investment in some flood mitigation there. I mean, the technical project has been done, but the council wants to understand, okay, so what's the insurance ramifications for them and their assets, but also what's the narrative that they can take to their community about the investment in that long term as well. So I think just having the relationship, I think at the outset is going to be useful for the longer term planning.
Thank you, Madam Chair. Chris, with the recently announced adaptation framework from government after quite a long gestation period, which obviously you were involved with closely, is there anything in that framework as announced that you see or your council sees as a potential problem or difficulty from a policy point of view? That's part of the question. And is there anything that your council would have preferred or would have liked to have seen in there that's not in there?
Yep, I think speed is one of the things that we pointed out at the beginning. We think the framework is a good start, but there are some unanswered questions. Mindful that I'm sitting around with the council at the moment, we want to see what the funding formula is or what the funding intentions are for some of the infrastructure and risk reduction that we think is necessary to happen around the country, even just the early stages of thinking around that, which we think will need to come at some stage. I mean, there are some good things in there that we're kind of just starting out on that journey at the moment. I think the discussion around a national flood map and making sure that there's a uniform map for the country, in theory, is a good idea. I think it will enable government, local councils and potentially communities to kind of understand with more certainty what the flood or coastal inundation risk is there for them. We're having some challenges at the early stage of that process to make sure that we are clear what that map is actually going to try and achieve. But that's part of the process. I mean, I think that the funding issue has always been the big problem, regardless of which administration is looking at the adaptation issue, and that question hasn't been answered yet. But we do think that there's a couple of issues in amongst the 4 pillars there, the national flood map being one of them that could potentially be quite useful, but that's on quite a quick turnaround. So I think I'm going to be interested to see how that project progresses. Adam, did you want to jump in there with anything?
Yeah, I'll just pick up from that flood map piece, Chris, because I think you got to look at why is the minister so hot on a flood map, and you got to say, well, in service of what? Obviously, the first order question will be risk to life, but I think the second order question will quickly then be, is that space on the map insurable? And so I think the worst case scenario would be if the government then goes and develops a map that's outside of any input from the insurance industry, because you could imagine a situation where a consumer looks to the government map and says that property is all good when it comes to the government's approved map, but then they go and talk to their individual insurer, and the individual insurer says, oh, no, that's their map, not our map, and our map says this, and therefore we're not going to insure it. So we need to ensure that whatever the data source is, that it's actually something that, again, New Zealand Inc. can have confidence in, that it's a true representation of that risk in that point. And to the point well made earlier, what are the mitigations that have been put in place that now might reduce that risk and make it more insurable? So to ensure we're all speaking the same language and we have one source of truth, I think is going to be critically important for that whole premise to actually work in practice.
Can I ask as a follow-up, who's the lead agency in developing the national flood mapping? Is it Earth Sciences? Is it regional councils collectively? Is there a lead agency?
So the lead agency at the moment is the Ministry for the Environment. And in our meetings with them, we've asked them quite strongly to make sure that they are kind of getting input from Earth Sciences, formerly GNS and NEWA, etc., because We think that there's a lot of data already in the system that could be quite useful. So starting from scratch and building something from a blank piece of paper might sound like a good idea to the NFE, but we do think that they need to make sure that there's already publicly paid for available data that can help in the effort.
A good example would be DSIR, Geological Survey, before GNS had actually mapped the liquefaction risk in Christchurch, right? And in the event of the earthquake in 2011, it was exactly what they'd done 2 decades earlier in the prediction.
I think you might be reflecting on the ability of the system not to join up.
And sorry to interrupt, team, but just on that one, because like the genie is already out of the bottle in some regard, in the sense that obviously since the regulation has been passed to now require natural hazard risk information to appear on LIMS, we know that, you know, for example, 50-year and 100-year flood maps from councils are now part of that process. And we're already seeing examples where, say, for example, banks are saying they're not going to lend in anything that's deemed to be a high-risk area. But they're only going off the science that can be surfaced through the information that's available at this point in time. And so again, having that one source of truth and ensuring that that one source of truth is very robust is going to be critical, because there's some pretty substantial decisions that are going to hang off those insights.
Yeah. I mean, one thing we haven't said yet is we want to make sure that people have got the right information to make some pretty critical investments at times in their lives, so they understand the risk when they're buying a property. And we are trying to make sure that the insurance sector is connecting with banks, as Adam said, but also with the councils. We all kind of feel like if we're going to deal with the adaptation challenge, it can't just be insurance itself. If it's insurance itself, then premiums is going to be the way we deal with it if it's not a connected solution here, and that's going to be a challenge for everyone if that were to be the case. So that's why we talk about risk reduction so much.
All right, councillors, I've got councillors McMillan, Vanderboom and Campbell.
Oh, thank you. You've answered most of my questions in terms of I was thinking about getting the head of the curve, but Councillor Grayling, your sort of answers to her about the local planning and having that real visibility up front so that people can see from an insurance perspective, which is kind of adds extra weight on not doing something in a flood prone area or whatever. But I suppose it's the bottom of the cliff with managed retreat and existing, which you touched on there, where I suppose my question is, do you think ultimately insurance and the banks, as you touched on, will actually be creating the shift because policy can't act quick enough? Or what do you actually think will happen? Because obviously you guys, like banks and insurance companies, can be really reactive, and they, you know, they could actually shift a whole bunch of change with something like a required managed retreat or managed relocation, whereas policy might be quite clunky and long term, and obviously not best practice. But what do you think will play out in reality with climate change coming at us?
I might just take a general stab at that, because there's so many inputs that could kind of affect what precise action you might take. But I think some of the reality is that a market will respond the way that a market will. And if there's an underwriting scenario where one of our members would say that you know, the price would be kind of unfathomable to a consumer, or that the appetite of the insurer isn't to offer cover there anymore, then there's a market reality there.
Yeah, and then they can't get their mortgage. So
and look, the banks have been pretty clear to us. We had a conference earlier this year. The banks are pretty clear that no mortgage without insurance. That's the reality.
So that won't change. You don't think that would ever change to accommodate that?
No, look, I think it's.
I'm not saying it should.
It's a relatively well entrenched system. You know, a bank wouldn't just leave itself open unless
Yeah.
there's insurance. I think, I know it's an open session, but I think the banks are well aware of the long-term risk to their mortgage book here, of the increasing and heightened risk of climate-related events. So we kind of are making sure that we're talking to each other, and we can't do that in isolation just with the private sector. I think we need to make sure that everyone is lined up to make sure that we can best protect communities. I think there's a sweet spot where the councils, the government, banks, communities, and insurers don't understand the bigger, longer term risk or an adaptation and can make some quite difficult decisions, but the market will keep operating like that.
Thank you.
Adam, you've got anything to add there?
Yeah, I suppose my point that I'd add to that would be I just don't think we can afford for that scenario to play out where the commercial dynamics are well in advance of the policy dynamics, because as Chris has said, no insurer wants to be the insurer of last resort. So if all insurers start exiting the market, then you do not want to be the last person holding the can.
And it would be inequitable, wouldn't it? Because always the people who can't afford it will be the ones that suffer the most. Always.
Correct. And then if that scenario starts to play out, then unfortunately what we've learned from other markets and jurisdictions is then regulators will then look to step in, because to your point, it is deemed to be unfair and inequitable. They then start to put caps on cover or caps on pricing, which then means capital can't get a return. And then you become California, where basically no one then wants to participate in the market. And we get into that situation where we started the conversation, where reinsurers say, we're out, we're not going to do this. And then insurers quickly follow and say, well, we're out. And then New Zealand goes from being one of the jurisdictions with the highest level of coverage on houses in the world to potentially one of the lowest. And that's not good for anyone. So we are all in this together, and we need to be for the good of New Zealand Inc.
Thank you, Madam Chair. Thank you for being part of this proactive engagement with regional councils. I wanted to go back to some of the conversations around the data sets that we have available for decision making. Some of those we've talked about are public facing, like flood mapping or liquefaction mapping or LIM reports. And Anna touched on our decision making challenge was around infrastructure spend versus insurance gains for our people. So my question is for you is around the transparency of the data sets that you have access to and how you're able to share those with us and by default with the community. So what is that level of transparency? And I do have a follow-up question.
Yeah, look, two sides to this answer. Some of our members will have data that they use for their underwriting purposes. They hold that pretty close for commercial purposes. But I want to give you some confidence, but also it is very early days that the Insurance Council was kind of aware of this. So we've just embarked on a piece of work internally as well to establish a data platform where we might be able to start aggregating sector data in order to have some of these conversations with central local government to get them a bit of an idea of what the kind of insurance claims or risk might be in the area to lay up over that. I want to keep expectations in the right place because we've only just kind of signed this off in the last 2 or 3 months. So it's still very early days, but I think Adam and the board are well aware that in an Inc sense, bringing part of the insurance narrative to these Inc conversations is really important. We haven't been collecting that data for that kind of purpose until having these conversations in the last 12 months. So we're kind of readying ourselves for some of those discussions and being able to bring some, some hard data to those conversations from the sector itself. Adam, I think from a board perspective, if we've got a perspective there as well, I think this is certainly something that the board has been quite ambitious on and kind of sees it as a sector role to make sure that we're feeding into these conversations.
Yeah, and strategically, that is the 2B state that we want to get to. So we're not there at the moment. But to Chris's point, we have made the decision as a board, as a council, that that's what we want to do. We want to get into a position where we can share our data at a aggregated and anonymized level with local and central government to be able to say, this is how we're seeing the risk in any particular spot on the map. And more importantly, if local councils and or central government invest in these sorts of mitigations, then this is how we think that risk may be moderated, reduced, and in some cases completely mitigated. So that's kind of the nirvana of where we want to get to. As Chris has said, what we now need to do is figure our way through all the commercial arrangements, all the anti-competitive type dynamics that are currently in the way of enabling us to do that. But certainly we have made the decision strategically that that's where we want to get to for the good of the country. And if we do that, we would be one of the first jurisdictions in the world to actually enable that to happen. But it's in essence what we did off the back of Cyclone Gabrielle and the Auckland anniversary weekend floods, where we all pulled our claims data, gave it to in an anonymized fashion, gave it to an independent third party who was then able to share that with government, that then helped inform those land use decisions. Thanks.
Brilliant. Thank you very much for those answers. It's fantastic. My follow-up question is really around us as regional councillors getting a sense of perhaps nationwide or perhaps region-wide, how many properties or what proportion of the property market or business market is either uninsured or uninsurable?
So that's been quite difficult to get with some precision. We've got a piece of work internally that is hoping to give us a kind of macro national view of that early in the new year. I'm not quite sure how deep we're going to be able to drill down into, for instance, regions. You're not the only group of people who want to understand that too. The Reserve Bank is quite keen, Treasury is quite keen. I mean, traditionally New Zealand has had high levels of insurance around people covering their homes. I think right here and now there's obviously a cost of living challenge, so there's lots of questions about that. But again, to make sure that we're informing the Inc. discussion about the kind of risk and the affordability and accessibility of insurance, we're hoping that we can collect that figure early in the new year.
Thank you very much.
Councillor Campbell. Oh,
Got one more quick one.
Councillor McMillan.
Oh, thank you. Sorry, just one more quick question. Do you ever have the position to advocate for nature-based solutions in terms of the bigger picture of climate adaptation and, you know, room for river, upper catchment canopy protection and planting, all of that sort of stuff, mountains to the sea approach?
Look, in amongst the conversations we've had around investment in risk reduction infrastructure, certainly we've had some conversations around nature-based solutions. I think we've connected with Aotearoa Circle in the last 3 or 4 months.
Yeah.
So, you know, just to understand some of their work. So in amongst the kind of traditional infrastructure work that you'd kind of see put in place that would support in a risk reduction sense, just trying to make sure that we understand that there's another branch to that as well.
Yeah, no, that's really exciting to hear because obviously you guys have got a lot of grunt, and to get behind us shaping in that direction in terms of that being best practice and future proofing, it's great to hear that. So thank you.
I think Adam was the one who got Aotearoa Circle in touch with RCNZ as an organisation. We've had a couple of interactions with them, and we'll do in the new year as well. So it's, you know, in amongst the mix, and certainly that was part of the conversation that we had in London with an engineering firm who's kind of looking at these projects and looking across the board. You know, there's some really clever nature-based solutions here that mean that we can reduce the risk and also build communities in a way that we can make them not just livable but safe at the same time, possibly even cheaper. I mean, that's just some of the things that they were saying. So I think just being mindful of all those different approaches.
That long-term lens. Yeah. Thank you. And thanks, Adam, for that.
Councillor Kumar.
Thank you, Madam Chair. Just one small question. Councils take a lot of responsibility regarding around mitigation, set very high standards in planning to make sure that, but as we all know, insurance is for the need of unforeseen circumstances. But is a premium reduction a dirty word in the Insurance Council framework?
I wouldn't say that. What I would say is we are a kind of go back to some of our earliest comments. We're here for the long-term sustainability of the market, and for the protection and safety of communities. Look, it's a challenge with pricing at the moment across the board, not necessarily just because of the insurance market, but just of the general cost of living. We want to make sure that, one of our priorities amongst the three of accessibility, resilience, and the regulation work we do is accessibility. So it's not just the price at which you get insurance, but the fact that we still have reinsurers sending that capacity of reinsurance here to New Zealand. I think what we want to make sure is that if we do have risk reduction measures taken, that what we say is generally there's going to be a positive experience with the premium because the risk has been reduced. As I showed at the outset, with the pie graph, there's a whole lot of other factors that go into the pricing of a premium, which we are out of our hands. But I think we can take a sharper look at that 46% side of that pie graph in an underwriting sense for the market conditions at the time, which would be much sharper than what you'd have if there's no mitigation. I think the best example I've got of this, not too far away from here, is we had to go to Wairoa earlier this year to have a chat to their community because there was a little bit of unease about whether or not the flood mitigation program should happen. We went to that community and said, the money is there to do this. You need to do this in an insurance sense, because if it doesn't happen, the accessibility insurance for this community long term is going to be a challenge, not just to the residents in that community, but there's some industry in those communities as well that would find insurance a challenge. And if they found that too much of a challenge, then employment would be a challenge within that community as well. And I think this is a issue that Adam is big on. It's, while we're talking a lot about consumers in a residential sense, the availability of insurance goes to the kind of economic viability of communities and making sure that we keep insurance accessible to not just households, but also to the businesses in those communities is really important for the long-term sustainability of those communities. Adam, do you want to add anything to that?
Yeah, and just on that, Councillor, so, each insurer will have their own commercial and economic model based on their own view of risk in any particular area, but certainly premium reductions are not a dirty word. So, for example, for us at FMG, over the last 6 months, we've just passed back around $35 million worth of premium reductions. So, yeah, we and again, because we're a mutual, that's kind of how we operate. We're not necessarily there to maximise profit. So, so where we have the opportunity to pass back premiums, and we can do so in a sustainable way, we will certainly do that. Thanks, Chris. Back to
Any
you.
other questions? Any other questions, councillors?
Thanks, Madam Chair and councillors. It's invaluable for us to be able to speak to this morning. So on behalf of all of us, thank you. We'll make sure we leave our contact details with you to make sure that if you want to make contact with us, then we're happy to do that. Yeah.
And on our behalf, I thank you and your team. Chris, thank you for coming and sharing with us. I'm sure we'll be in contact.
Thank you. Thanks, Adam.
Thanks for your time.
Thank you, Adam.
Yeah.
Thank
Ka
you.
kite.
Kata, thank you. Ka kite. Enjoy the rest of the day.
Thank you.
Thank you.
Yeah, I know. Yeah. Lucky last. That was good. That was very helpful. Oh, they're not working. Yeah, let's just carry on.
Good.
Kia ora.
So we can smack each other.
Kia ora, Mark and the team. And kia ora to you, Karen, online, we're on Zoom, can see you on there. I'm not going to take up any time. We will have a discussion and we know why you're here and we're looking forward to the presentation.
Very good.
So I will hand over to you.
Kia ora, and thank you for the opportunity to present. The purpose of today in this session is to talk through our results for the year ended 30 June, which are both in our annual report and on the website. But before we do, there's a couple of people I'd just like to introduce. Last week, we didn't have Fraser Winneray, one of our directors. So Fraser, perhaps you'd like to say a few words.
Thank you. Tihei Mauri ora, kia mata moana, te rangatira mai o toi moana, tēnā koe. Ki te mana o whenua, te rangatira, o toi moana, e mihi ana i a kupu whakatau ki a mātou. He rā nui tēnei he waka katahi a tātou, ki a rangatira ai nai whakaro, e na wawata mō a popo. Nō reira, e konei tātou e hoe tahi ana i te waka kōrero nei, tēnā koutou, tēnā rā tātou katoa. Very pleased to be here. Unfortunately, last Monday I was between Department of Conservation huts on the Great Barrier Island, which fortunately doesn't have mobile coverage very well, so that's great. So I'm very pleased to be here to serve the Bay of Plenty community on the Quayside board and also to serve on the Port of Tauranga board through that. I have a background traversing most of the primary industries in New Zealand in investment banking. I was the CEO of Mercury, CEO of Fonterra, to help support its turnaround of the core business and get it through COVID-19, and was the chair of the Business Advisory Council to the Prime Minister Ardern. I have been in that Fonterra role, the largest customer of the Port of Tauranga, and been directly involved in a lot of economic decarbonisation in New Zealand, and have experienced long-term Māori partnerships through Mighty River Power's geothermal work with Māori land trusts, particularly Tauhara North No. 2 Trust and Te Arapaki Trust in the central North Island. I care for the kaitiaki and quality of governance and its sincere responsibilities, supporting the management teams with clarity in times of change and uncertainty, and speaking up when there is contradiction or ambiguity in the kaupapa. So I'm very pleased with the support we've been able to provide Quayside management in its remarkable 2 years of reform. They can be proud of the achievement and the direction momentum, but the work is never finished, and so we'll get on with the mahi nui, won't we, Lyndon, and keep going. Nō reira, tēnei te mihi kia koutou katoa.
Thank you, Fraser. And there are two executive, I'd just like to introduce Davide, who's our GM of Finance. You get to talk to a lot of the presentation, and hiding down the back somewhere is Mel Manley. This is Mel's last presentation to the council. She has been with us as GM of Operations for 5 years, and she's trying to hide. So I thought I'd just say a few words. So on to the presentation itself. So we're going to go through a standard agenda, which you've seen, but the key messages for today are really around the changes that you'll see in the accounts that we're presenting is all part of our relentless pursuit of high performance. We are absolutely committed to preserving and growing that real capital that we look after on your behalf, because that gives you real growth and dividends in the years ahead. There is a need to engage around future proofing. There's a lot of change going on in your world, and most likely it will spill into our world as well. And the last part we'd like to update today is the execution of our Rangiuru strategy and potential ways forward. So that's pretty much it from me. I'm now going to progressively hand over to the rest of the team.
Kia ora. Kia ora koutou. Look, we always sort of touch off on, kick off with our vision and our purpose. Without this is something that, for the team, we hold incredibly dearly to our heart. I have to admit, it is what gets us up in the morning. And it is a critical component of our employee value proposition, and that is the community focus that lies at the heart of our vision and our purpose. Our job, without question, is focused around delivering commercial outcomes for the council. I just want to again touch on how we look at the various three portfolios that we do have under management. They are very different in terms of their risk and reward profiles. And what we have done is tried to break this out into three different, three different portfolios. We've spent a lot of time looking at our cost to serve those various components. And this is ultimately designed to provide our stakeholders, one of which is clearly yourselves, but that of the community, a very clear view around the performance of those three portfolios. So complete and utter transparency around the performance of those three distinctive portfolios. I'll now hand over to Kieran, who is our Audit and Risk Chair.
Kia ora. This year again, KPMG were our auditors. Hopefully you can all hear me okay. We also have Audit New Zealand as the auditors for the Toi Moana Trust. So the key areas of accounting judgment and audit focus this year were a simplification of the accounting disclosures to enhance the readability of the financial statements, and you'll see that in our annual report, as well as streamlining the audit process. So KPMG have been a good partner and have been quite proactive in how we can streamline the audit process and enhance assurance throughout that process. Valuation of our investments is always a key audit focus, and this year there was quite a bit of focus around the Rangiruru valuation, and that valuation, well, first of all, the classification and then the valuation method. The valuation method changed from a market comparative to a discounted cash flow approach, and that did have an impact on the value of that investment, of a downward valuation there. Another key focus area was the treatment of the Rangiruru FinCo, or overhang, you might hear us talk about. So that's a pretty complex area. The classification of the expenses needs some scrutiny, and also the tax treatment of the FinCo. Given its complexity and the quantum, we've decided to seek a binding ruling from IRD on the treatment of that, and perhaps bring the tax deduction of some of that expenditure forward. All the audit opinions were unmodified, which means, they were clear, they were good, and there weren't any substantial audit recommendations coming out of their work. The financial statements were published in accordance with the deadlines that we need to meet. And we also published our climate-related disclosures report again this year, which has progressed further. And I'd encourage you all to have a look at that if you haven't already. It's a great summary of the impact we have on the climate, the impact that climate has on our organisation, and how we might understand those risks and transition to a more resilient future. It also deals with what is our role in a just transition when climate change impacts become more prevalent. And I would just like to shout out to the team. They might not say this themselves, but there was some very positive feedback given from the regulators on our report as an exemplar. So, you know, that was a great result. And of course, now we're focused on the transition planning. So what do we do with all of this information that we've drawn together, and how do we plan for a more resilient future? And just to note that the financial statements for all of the various subsidiaries and the special purpose vehicles have all been finalised. Over to you, David Day.
Nikoto, and thank you for your time today. It's good to be here. One of the opening remarks that I would like to introduce this presentation or this slide with is, given the new councillor, is the numbers that you see in this presentation are different from what you will see on the published financial statements. This is due to specific accounting issues for which we need to consolidate all the numbers from the report, which heavily dilute the performance and the way of delivering meaningful results to the readers of the financial statement. This kind of presentation actually, we believe, reflects better the operational performance of Quayside, and it delivers definitely an easier way to interpret our accounts. For the financial year 2025, we have recorded a net profit after tax of 56.6 million and 66.5 on a normalized basis, with the exception of the Port of Tauranga dividend, which remains the big anchor of and the big contributor of our operational performance. Unrealized gains, as Kieran mentioned, and the overhang remain two of the biggest drivers of our operational performance. While we'll dig more into unrealized gains later in the presentations, it's important to note that the overhang or the FinCo write-off will keep on impacting negatively on our accounts in the foreseeable future. And it's also important to keep in mind that its recoverability remains very uncertain. In the past, probably 3 years, we have navigated a very challenging economic environment, which put a lot of pressure on Quayside. And as you may see, Quayside didn't have a lot of capital for growth. Not only this, but the investment portfolio in the last couple of years has also funded expenses that were port or special purpose asset related. Looking ahead into 2026, we do see improvement in the conditions. But please keep in mind that the 97 million that you see here as a normalized NPAT is heavily impacted by what we call paper gains. So that can fluctuate really heavily depending on market movements. What I would like to focus on is the net operational cash flow, the 67 million for 2026. And based on this indicator, we keep on seeing sign of improvement, which are captured by a reduction in the payout ratio that went from over 90 to 86%. And further improvements are also envisaged for 2027. This slide links back to the three portfolio approach and strategic clarity that we have spoke about before. This is the first year where we have had to identify from an accounting perspective also those three different segments: port, investment portfolio, and Rangiora Business Park. You will see that corporate costs are still separately treated and unallocated, but one important work stream that we are concluding this year is what we call the cost to serve. So how much it costs for us to serve all of those three buckets, and that's independently reviewed currently by a third party. And we expect that the results of that work seem to provide a lot more clarity for decision making and transparency for everybody. As we said, unrealized gain is part of the operational performance that we are really focused on. Is very volatile. You would have seen a 5 million unrealized gain in the initial slide I presented. That said, the investment portfolio contributed very positively to that number, $21 million of unrealized gain in the last year, which was heavily offset by a fair value reduction, as Kieran already mentioned, on the Rangiora Business Park. What we need to say is that the valuation of the business park, despite all the challenges, we believe is still really conservative. So depending on the land sales, we expect to see positive results in the next couple of years.
I may just pause there and see if there's any questions, any partai from the councillors.
Oh, thank you. Just with the cost to serve, is that broken down into the 3 buckets? So so out of interest, out of that 9, how much is Rangiora, the 3rd bucket or 3rd?
So came back as an initial assessment, came back almost, depending on the time allocated and activity, 30% for each bucket. We wanted an independent assessment to understand how specific costs had to be allocated, but it's around 30% on each bucket. So 3 million, 3 million, 3 million.
Yeah. And with the, sorry, just another question completely unrelated, but with the Rangiora valuation downturn, does that have an impact on sales potential?
No, it's just a reporting number. Actually, one of the big assumptions of the valuation is the sale price of the parcels of land, which was assessed as being $500 a square meter in the valuation. But what we have seen now is over 600. So as the lands will come in and become more evident what the sales price we can achieve is, we can then capture it in the valuation for report. Reporting is always, I would say, a bit conservative.
Yeah.
We tend to stay a bit conservative on the report.
Okay, thank you.
Okay. So look, we thought it really important just to reflect on the year that was around how we've performed against our FY25 statement of intent. So look, I think as a more general statement, we're pretty darn proud of the achievements over the last 12 months. I will just highlight a couple of key components there in terms of that scorecard. The progress that we have made with Rangiora Business Park 12 months ago, we were bringing sections to market. As you well know, economically it was a pretty challenging environment, so there was a fair bit of uncertainty. And I will touch on it shortly in the presentation. The uptake so far has probably been beyond our expectations, which is fantastic. And also when we sort of cast our eye across the wider marketplace, when we reflect on other industrial developments such as Ruakura, the uptake has actually been higher in Rangiora and then other developments. The team engagement score, that is something, we talk about having a really engaged place to work, something we monitor every year. That has been year by year continuing to increase, so it's now above 80%. And I've got to admit, I'm pretty thrilled to be part of such an exceptional team. The hard work that we've been putting in place in respect of getting our foundational documents bedded down, things, key documents such as our statement of investment policies and objectives, also known as our SIPO, the establishment of our investment committee, and all this is around very much designed to bring a higher level of corporate discipline and maturity to the way that we are making decisions. And then it's all very much with the to fulfill our underlying purpose, which is to grow an intergenerational fund and ensure that we provide a stable and growing dividend back to yourselves. Looking forward, so this is the year that we are in, so FY26 statement of intent, and they were the key themes that we touched on at that particular time. Again, reinforcing the need to provide a resilient and growing dividend to yourselves, that having an endowment fund really does support the underlying dividend that we provide back to council. maximising the Port of Tauranga value. And I think just, if I was to sort of emphasise on or focus in on that, the work that we have been doing with the port, or the influencing and conversations been having with the port, what you have seen them come out from a commercial perspective in the last 12 months is a really clear intention around improving their return profile. So they now have a stated goal of a return on invested capital of 7% within 3 years, and lifting that to 9% in 5 years' time. And I think that's a very good example around some of the commercial conversations that we do have as the majority shareholder with the port. And then the last one there, just again reflecting on the engaging place to work, a very strong focus from the team around employee engagement, cultural competency, and as Davide and Kieran referred to, just building up our climate change resilience as well.
Since I'm the Quayside representative on the port board, I'll just give a couple of comments here. I won't cover the comments on the slide, which can be read, and you'll get a full presentation from them if you haven't done so in due course, and that's good for them to tell their story and preserve their mana. But basically, the port exports land use, which is photosynthesis, and it's an import basis for what the economy and society needs. That's what it does, and it needs to do that in advance. It needs to have the capacity to do that in advance of those societal needs or the landowners wanting to export, and that's what is a key focus for the port. It's been a very solid year. I think I'd highlight the Northport and MMH transaction, which was involved about 5 parties. It had a 20-year gestation from the original purchase of 50% of Northport, the small port itself, and it's strategically very important for Quayside and the port for the next 50 years. There is a lot in front of it. It has plenty of work to do. Some of it hasn't been done recently in corporate history of the port, and so it is very much occupied with thinking about how it executes very well, because if it doesn't, then the share price multiple that it's got at the moment, which is based on future growth, might not necessarily come true. So we're very conscious of getting on with good execution now in several locations. Safety has been a big focus. Environment has been a big focus. We'll be commissioning and opening a stormwater system on the port on the Maunganui side, which also serves the residents of Mount Maunganui as well. There's more resanding at Pilot Bay, Coast Guard, Lifeguard, etc. Those sorts of engagements. The iwi matters have continued to require sort of improvement. Our community survey is strongly support at 84%. Just one last comment on the port as we're thinking about its ultra long-term future. The biggest strategic risk that I think about is New Zealand not being able to export directly to export markets and having to hub via Australia. And to do that, you have to have somewhere where the ships can come, and those ships keep getting bigger, and we have to have them arriving. Otherwise, we will be a coastal hub for Australia, and I can bet you that's not a good outcome for the very people that need to export their produce. That's not imminent, but it's just, if we're thinking about what really would be a super failure in 10, 20 years, it would be that we can't do it directly with services for our exporters to get their high quality produce to market. But I think a very solid year and some very exciting years ahead would be my summary for the port, but there's still plenty to work on. I don't need to go into Stellar Passage. We've all probably traversed that, and the port can cover that directly.
Just to put a bit more meat on the bone around the investment portfolio performance, the numbers there are sort of a gross 6.7 and a net 6.3 for the year. It's important to note that they're different numbers to what you saw last week. That's probably a result of a really strong first quarter that we've had for this financial year. The key number we look at is the 7 net 5-year rolling, which is our statement of intent target. So we're in line with that. And really, for us, it was a year of 2 halves, a little bit what Davide talked about in terms of paper gains. Most of that 6.3% was made in the first half of last year, which feels like a long time ago, but you'll remember that there was a lead up to Trump taking the presidency, and you also had the emergence of AI and a whole heap of investment into data centers and energy, etc., which really buoyed the market. Then in the second half, we had a whole heap of volatility around, trade wars, Trump and how he was acting. So a lot of those gains were given back to get to a 6.3. Another key part to mention in what has lagged the portfolio is that we have a high exposure to New Zealand companies in that. And as you will all be aware, the last sort of, especially from June, New Zealand economy was still struggling and is still coming out of a recession, essentially. The private equity as part of that is also a key lagger. The way private equity works as an asset class is you are not getting day-to-day mark-to-market pricing, but so we're not losing value there and the companies are still performing well, but we won't really see the valuation upside until those managers get out and run sale processes and sell those assets. In terms of the highlights, really important to call out, we did a lot of work last year on a SIPO review. A SIPO review is something that we do regularly every 2 or 3 years. We took a really belts and braces approach to it this year as a result of a potential transaction. What that involved was getting an independent expert to come and assist us. They did a gap analysis of our document, and really importantly, what they did was they stress tested our assumptions around asset class performance and our strategic asset allocation and how that aligned with the council's long-term plan and the probability of it being able to achieve success of delivering a stable dividend. In terms of performance, global equities was really strong, delivered above benchmark performance of 11.7%. We changed strategies through the year to be more direct and pull out of Australia to be more global focused and get access to some of those big macro trends and be more diversified as well, away from New Zealand. And we also had a really good performance with our fixed income portfolio, which we recognised that it was underweight in global fixed income. So we've allocated a lot to that recently, and we were also allocating to new bond issues as they came up. So that was strong performance. Also calling out our real asset investment, which is predominantly a partnership with the Maori trustee, Tuma Pairo, which is invested in kiwifruit on Maori land. That is starting to mature, that asset, and is, as you know, it's kiwifruit in the Bay of Plenty, so it's throwing out a lot of income. So that were the key highlights. What you'll see here is our portfolio asset allocation. As a key part of our sort of day-to-day, we are constantly balancing within these bands. These bands have been tested by that independent advisor as acceptable levels, but we're trying to get back to the red lines. And the key one there is that global fixed income. We've allocated $15 million to that recently, and we'll be getting closer into that band in the next sort of 6 months. It's a key defensive asset class for us. Private equity, as I've kind of mentioned, is probably the biggest concerning one at the top of its band. We do think that will shift in the next sort of 12 to 18 months as those managers start selling assets, and then that gets converted into cash and then goes back through the portfolio. So that is probably a slide you'll see regularly from us.
Thank you, Sam. Look, I did mention Rangiora Business Park. I mentioned 12 months ago, no section sales. We had a wonderful opening in early February with Minister Jones cutting the ribbon. And for those that were present, I've got to admit, it was one of the sort of more prouder days that I have had as a leader. And that I have to also acknowledge Tapaweka as mana whenua and the role that they played on that particular day. It was a first-class opening. I'm proud to say that we have, I think when we spoke to you all in our induction, I think I mentioned around 9.5 hectares of land either sold or under contract. In the last week, we have another 1 hectare via 2 sales that we have added to that list, which are still conditional, but nonetheless, it does show there is a degree of momentum around the park. While some of that momentum has slowed down, we are very much gearing up for some strong market announcements in the new year, where we will start to bring to market who are these new tenants and who are these sections being sold to. And I think that hopefully will add to some of the momentum that we are hoping to establish in 2026. Probably one thing I will highlight is that in our forecasting models, and Davide's given you a bit of a sense around where some of the value points are at. If we are to sell all of stages 1A and 1B, we expect that to generate about $183 million worth of section sales, which will be utilised to or to apply to debt repayment. That would still leave us with a component of around about $54 million worth of debt. As you may be aware, and I'm looking forward to hosting you out there in the new year, we have a high producing kiwi fruit orchard, which is stage 2. So that does go some way to servicing that. But we are at some point in the new year, we'll need to explore how do we look to what are we going to do with stage 2 with a view of clearly looking to relinquish more of that that residual debt profile. So just some key messages there. The wetlands, I think, in time will be something that the council, the group, and the community will be incredibly proud of. It's a 48-hectare wetland designed to capture any sort of stormwater requirements with 1 in 100 year type weather events. We think it is the largest engineered wetland in the country, and the involvement with Tapaweka in this respect has been absolutely fantastic, and very much looking to showcase that to you all next year. I have mentioned that they're very reliant on maintaining section sales momentum to continue to de-risk. Already spoken to the level of sales activity that we have, and in the new year we will be working with the board and our investment committee on exploring other options, or the options that we do have available to continue to de-risk the project and also deliver to the regional outcomes that were originally intended.
Speaking up. PPS, as you may know, we do have 200 million, as a group, we do have $200 million of listed debt on NZX. Just a few facts around the instrument. It currently pays 478 as a cash cost to PPS holders. We can benefit from imputing all these dividends given the existence of an IRD binding ruling, which is due for renewal in September 2026. It's an important and key year for the PPS because of the binding ruling renewal, and in March there will be an interest rate reset, which will set a new level of costs. It's also important to remember that there is the PPS holder have rights to call on Quayside in case the port is sold under a 50.1% ownership. On the ESG side, as has been anticipated before, we have released the second climate-related disclosure this year in October 2025. It's been a journey for us. We've learned a lot, but there are new regulations coming into play, which will basically exempt Quayside from producing a fully compliant CRD report. That said, we are still going through a process to understand how much we can actually, or we want actually to retain from what we've done and what we've learned. In the first quarter of the next year, we'll probably have more clarity on that, but we definitely want to keep on working on our transition plan and keep on basically delivering value based on what have been the learnings of the process. Some insights on that are about capital preservation, ability to distribute, and license to operate. We've approached the report using these 3 big pillars in line with our strategy. From a distribution perspective, we are really reliant obviously on the port ability to pay as a dividend, which is the major funder of the dividend to BOPRC. There is obviously some stress on that side. If you look at a very stressed scenario, which is called hothouse, and it's really important for us to risk manage this side of the things. From the ability to preserve capital perspective, we do have a very well-diversified investment portfolio, and we have integrated in the last couple of years very good risk management tools when we select and try to manage investments in the due diligence phase and the monitoring phase.
I think as a bit of a summary for councillors on this as well, there has been a significant amount of effort and cost associated with adhering to the climate-related disclosures requirements as part of our New Zealand Stock Exchange listing. Whilst there has been a cost, there has been also some great learnings. And I think the part that we are going to just consider, given we are now exempt going forward, is where do we find that balance? I think just to stop may not be the right approach, but to do the more fulsome report, which takes a huge, we think it's around sort of $400,000. We just need to find that balance. And I think that is something we are working and will intend to work very closely with the council executive as well to ensure we get that balance right.
And so to pull it all back together, key messages are Quayside is the kaitiaki and high performing manager of your endowment fund for the benefit of obviously the broader Bay of Plenty region. And we do that by ensuring that you have a real and growing dividend. And to achieve that, we need to preserve and have a real growth in the capital base. Looking forward in the world of change that's washing across all of us, future proofing for the environment of the region and the people of the region is something that is really becoming front and center and quite urgent. And last but not least, we really look forward to hosting you out at Rangiuru in the new year and showing you the industrial park. So very happy to take questions, Madam Chair.
Councillor Vanderboom and then Councillor Dougal.
Thank you, Madam Chair. Fantastic presentation and report. Thank you so much for that. As a newcomer to council, I wondered if you could talk me through some of the detail. I'm referring specifically to page 14 on the Toi Moana Trust financial statement. And you skipped over some of the detail around the New Zealand equities investment. And it's noting the losses over the last 2 years. I wondered if you could just guide me through the SAA within the SIPO that helps you make your decisions in the face of those growing losses.
I can talk to the New Zealand equities piece. So it's not so much a loss. So we have a direct portfolio which we manage with another consultant, which is First Cape or JB Ware. That is a mixture of predominantly NZX 50, but it's probably more like NZX 20 companies. So the larger companies in New Zealand, which are safe and steady, they will go through up and downs with the cycle. As a key example, you had EBOS, which is Animates, and various other things. They had a poor performance, a lot of that driven by consumer consumption of their products. So their share price went down in the period, but then at the same time, you had other things like A2 Milk, which went up. It's not a negative performance, and it's definitely not a crystallized loss. It's just the volatility of the share market. The way we build out our allocation to that is we have a capital market assumption for how that asset class will return over a 10, 20-year period. We then cross-reference that with other providers to sort of know that we're in the ballpark. And then this year, we even had an independent come in and assess that as well. And then that feeds in with all our asset classes into what's called a covariance matrix, which essentially is how all those asset classes talk to each other. And that sort of spits out a number that says you should have X amount in New Zealand equities. And then on top of that, we then run Monte Carlo simulation on the makeup of the portfolio to sort of say, if the portfolio is constructed in this fashion, it'll spit out this at a certain probability. Yeah. Sorry.
Thank you. So what, how reactive is that model, the two different models that you're working to? Is it something that you review every 3 months, 12 months, 6 months? What are you working on?
That's probably more the art of it than the science. Like there's an element, which is our core fundamental belief that we're not traders, we're long-term investors. And so, and we're seeing it now. Whilst New Zealand didn't have a good year last year, the New Zealand stock market will probably have a pretty good year this year as people sort of get on board with it coming out of the economy and those green shoots. And it's probably a little bit of even, the port as part of that as well. So we don't muck around with it too much. There are elements of, hey, we're about to go sell some New Zealand equities to go put it into some global bonds. and we will look at, say, hey, there's a Fed announcement coming out. Is there a risk of interest rates rising and that impacting asset prices? But we're not really changing asset allocations daily. We're more trying to rebalance back to that SAA more than anything. Yeah.
Going back to that question, how often do you actually review the
Oh,
SAA?
every 3 years.
3 years,
Yeah.
right? Okay,
Yeah.
thank you.
And in respect of the portfolio allocation, it is something, so where we're outside of band, it is something that we have a very intentional strategy, or we have a conversation with our investment committee on what are the processes and the way that we are going to get back to weight. So that is something that we are quarterly monitoring. And for example, when you've got something like real estate, which doesn't have a very high level of liquidity, that takes time. So that is something that we just have to map out and work quite strategically with our governors.
Thank you, Madam Chair. Thank you very much for the presentation, and really good report, and outstanding work on Ranguru in a very challenging market over the last number of years. So well done there. My question more was to you, Lyndon, just specifically around the ESG reporting. You mentioned obviously the costs incurred in that reporting process to the NZX. You then also mentioned that there's an exemption going forward. Could you just explain it again? So I didn't quite understand that exemption was available to us, and how does that work?
Yeah, no problems. So look, there has been, we've met various times with, organisations clearly like the New Zealand Stock Exchange, Financial Markets Authority, and we have said as a debt issuer of sort of $200 million, there is a very heavy level of compliance and the cost of compliance. And the reality, sort of 200 million is not a sort of a big number when you sort of start thinking about market capitalisation of various stocks. The other part we've fed back to them is if you're going to encourage more debt issuance or more equity issuers onto the New Zealand Stock Exchange, some of these types of barriers will need to be, there'll be a significant cost for new entrants. And I believe they've taken some of this on board. And so the new regulations that are being proposed, and I believe are still yet to be passed through Parliament, are saying that they're going to increase the cap. I think up to $1 billion, isn't it, Davide? And so anyone below that are now exempt from having to do the CRD reporting. So that would see us not having to do any of this. And I guess the part that we're just reflecting on is there a sort of a CRD, is there a CRD light where we can take all the learnings, because it has played a role in terms of the formulation of our strategy going forward and how we continue to adapt the portfolio to build greater climate resilience. I just think to stop it completely may not necessarily be the right approach, but to do the whole, the whole report, I think has something, is an area that we probably going to also reflect on and go, is there a more balanced approach to how we report?
So you are exempt going forward? Is that correct? And I'd hope also there might be some, if that cap was lifted, there might also be some, appreciation of a look through to the Port of Tauranga, who obviously also do quite a comprehensive ESG reporting, and obviously it's a major asset that we're invested in. So there is a large amount of crossover there.
Yeah, very good point. The port will not be exempt.
Councillor Grayling, then Councillor Shirley.
Kia ora, thank you. That was a really good presentation, and I'm sorry I wasn't here for your briefing on Friday. This is a slightly not challenging one, because I know most councils and organisations and developers do struggle with assets such as wetlands. And obviously it's not a pipe in the ground or a concrete structure. And I'm just wondering, with our $54 million residual debt that we're holding at Rangiuru, have we used some natural capital accounting to quantify the benefits associated with that wetland? Because obviously if we can account for the carbon benefits, the infrastructure benefits, that we can actually hold it as more of an asset. And have we done that exercise?
Our engineers are actually evaluating that today. So they're taking into consideration the value of blue credits that you can get from that. But it's an ongoing work from John and Mark.
Because I'm conscious that they did quantify the value of the wetlands that were filtering water for New York City. And I think it came out at something like $4 trillion worth of assets. And they're going through the exercise of accounting for some of that not concrete structures. So I'm glad to hear that you guys are working on that, because that might look at that residual debt possibly different in light of that.
We would accept 4 trillion. That would be, yeah.
I think, yeah, so some, things like blue carbon, et cetera, is quite an emerging asset class. So it's very much in its infancy in this country. But we are starting to turn our attention to how could we derive a commercial outcome out of something that is clearly going to be a considerable community benefit. I think the other part too, that we should always have in mind is, if you're going to be, if you're looking at this as a future tenant or a future acquirer, the value proposition of Rangiuru with a 48-hectare wetland will ultimately add to a premium outcome in terms of the value uplift of those section sales. So we shouldn't lose sight of that as well.
100%. I think it's great to see that it's happened. It's just making sure if we can be the leaders and being the first ones that can actually use the natural capital accounting to actually put a value on the benefits that we've accrued from it. I think that would be fantastic, and we could be the trailblazers in that space, because it'll lead to good outcomes. But I agree that it will be realised in the actual land values and the sales, because people want to be paying the premium. So yeah, great. Thanks, guys.
The actual trade-off that is being considered is how much we can push the vesting of that infrastructure to Western Bay of Plenty so that we can benefit from that. So there's a bit of cost opportunity there to evaluate.
And Madam
Councillor Shirley.
Thank you, Madam Chair, and thanks for the report. My question again relates to Rangiuru, and that's the situation with the debt that's there and the proportion of that debt that is the upfront interchange costs. And of course, it's that interchange that makes the whole thing work in terms of connectivity. And as I understand it, we funded the whole upfront costs or substantially of that interchange. And when you compare that with Ruakura, which on the Waikato Expressway, fully funded by NZTA. I understand there's some talk of trying to recover some proportion at least of that. Good luck trying to get money retrospectively out of NZTA and the National Land Transport Fund. But there are other mechanisms. My question is, how actively are we pursuing that strategy with government and agencies to, just on the basis of regional equity and fairness, because that was a huge proportion of the cost. And of course, it is a toll road, and we have such a high proportion of toll roads relative to other regions. And a lot of that revenue is going to be related to the activity at Rangiuru, particularly with the heavier freight. So what strategy or how actively are we pursuing the argument to seek some recovery to address that inequity?
That is a great question, Councillor. Look, we have certainly been pushing that barrow. We have been stonewalled to a degree, and the door has been unlocked. We have been actively engaging with the local NZTA officials as well, and that has come, I guess, with quite a collaborative approach with council executive as well. So we're not trying to do that in isolation. The feedback we have got is getting funding in a once this has been completed is outside of their policy framework. So that makes it incredibly difficult. I agree with you. There could be an option around tolling that would require community consultation, is the feedback we've received to date from NZTA.
Probably trying to pursue it through sort of local NZTA is the wrong level. You really need a bit of political clout in Wellington to try and really pursue it, because it is a glaring inequity.
I agree, and we have raised that with some senior government officials, and we've also been to engaged with senior NZTA officials as well, and we've pretty much got the same answer at every single door that we've knocked on. Yeah. No, that's a very Very good point. So we were very close, well, not we were very close. The local office had approved the funding. So I'll just take a step back. $60 million to complete. We had $18 million from the Provincial Growth Fund. Meant Quayside was doing the sort of heavy lifting for 42. We had support from NZTA, Bay of Plenty Regional Council, sorry, the Bay of Plenty Waikato NZTA office. They told us to put the champagne on ice because it was going up to head office for sign off, and then unfortunately Cyclone Gabrielle hit, and at that particular point we were told to pause because clearly all funding was being reallocated to East Coast. So we had a decision to make at that point. Do we continue to progress with the development of or the completion of the interchange, which would have slowed down the entire pipeline and development of Rangiuru, or do we carry on? And clearly we made the decision to carry on. I still believe that is the right decision. I think to pause and having to go through a pretty elongated process to try and resolve that, I think would have stymied where we are today.
Councillor Graham.
Thank you. This is segueing slightly back to Councillor Grayling's comments about maximising the value of the wetland, but we've just had a presentation from the New Zealand Insurance Council, and I'm just wondering about the potential too for that, recognising the value of that wetland as part of climate resilience for insurance purposes for downstream developments downstream as well. So just
we'll have to pick that up. So we haven't got a line of sight on that just yet. But I think it is important to note that under the district plan, we do have a responsibility to transfer the ownership of the wetlands through to Western Bay of Plenty. That's the current Western Bay of Plenty District Council. So that is something that the team is working through. We have a high level agreement on how that is going to take place. There's been some good interaction with the Western Bay executive in that respect, but ultimately that is the current process in line with the district plan, is that Western Bay of Plenty District Council will take the ownership of that.
Through you, Madam Chair. Can I just ask a second question on what Councillor Graham was clarifying? Was the gifting and the vesting of the wetland to the to the Western Bay, was that in lieu of additional FinCons chargeable, like as a reserves and heritage contribution, or are they just getting that for nothing? We're not getting a reduction in our FinCon as a result of that vesting?
No. But there is contributions in respect that Western Bay of Plenty District Council have committed in terms of building a greater wastewater plant to future-proof both Rangiuru but also the Te Puke growth node.
Oh,
Kia ora koutou. Tēnā koe, Fraser. Mōhio pai ki a koe. Dr. Iwi Te Whau used to work for Tauhara North No. 2 Trust and did quite a bit of work for Mighty River Power and Mercury Energy. Nō reira, he mihi nui tēnā ki a koe. Just back on the wetlands sort of stuff, it just came to mind when both Councillor Graham and Grayling were talking about, and we were just talking about the loss of wetlands because of Rangiuru, and has that measured into factor about the discussions that we've just been talking about, the wetlands from the upper down into the lower area of the Rangiuru, especially with the new tracks or whatever that have been built in those particular areas. It just sounds like we take away wetlands, but we don't really do anything about it when it's gone. And is that a part of a sort of a factor that we can put into Western Bay of Plenty in regards to that consultation period with them to identify the importance of that wetland being developed in that area? That's the thought.
If you can let us take that away, because there's some new sort of concepts that have been introduced there. as well as the insurance component. At the moment, we are adhering to the district plan requirements, and yeah, that is still being negotiated, I guess you could say, in terms of a more fulsome agreement. So I do take the insights from councillors, and we'll add that to our thinking.
Any further questions, councillors? There be no further questions. Can I have a mover and seconder for the report to receive the report, please? Councillor Shirley, thank you. And the seconder, Councillor Grayling, thank you. All those in favour say aye. Aye. Those against, there are none. Thank you, councillors. Carried. This brings our meeting to an end for the day. Notwithstanding, we will have a session following. So, Councillor Defoe, can I turn to you to close our meeting? Thank you.
Tēnā koe, Madam Chair, o te rā tēnā tātou. Anō reira te mihi ki a koutou o Quayside e tau a tinana mai ki tēnei hui hunga. O te rā ki ngā kai arahi ki a koutou katoa, tēnā koutou. Thank you everyone for participating in today's council meeting. Madam Chair, thank you. CE Fiona, tēnā koe, o te rā tēnā tātou katoa. Kia wātea mai te tapu, kia wātea mai te arahi, kia wātea mai tēnei hui hunga, haumi e hui e tā e ki e tēnā tātou.
I did not thank you on purpose because I'm assuming you realise that you're staying to talk with us. So yeah, that's why I wasn't, thanking you at that point. Yeah. I think.
Karen, we're just muted, Chambers.